All right. Okay, I want to welcome everyone to Understanding Financial Ratios today. This topic is sponsored by the East Cambridge Savings Bank, and they will be here to answer questions at the end. Should you have any questions on how financial ratios relate to the bank. If he's ready, Robert, do you want to go ahead and do a quick intro to East Cambridge Savings Banks for us?
Sure, Teresa, thank you. And thank you everyone for joining the webinar this morning. SCORE has been a great partner to work with, and we continue and are willing to provide these outstanding workshops. East Cambridge Savings Bank is a mutual savings bank. We are not a publicly traded company, and we do not have investors. Mutual savings banks have been around since the early 19th century and are so common in New England. Our bank was founded in 1854 and has been operating with the same name and charter since then. We have never been acquired or sold to a larger bank. Since East Cambridge Savings Bank is a mutual savings bank and does not have shareholders, we reinvest profits locally through mortgages, loans for small businesses, and supporting nonprofit organizations. Thank you. Back to you, Teresa.
Thanks, Robert. Okay, so SCORE provides for you a lot of tools to help small business owners and those that are in the process of starting that small business. We work with folks that are in the beginning stages, considering and trying to decide if owning a small business is right for them. Those that are working on that business plan and trying to get things ramped up to get that business opened, and those that are already in business. Perhaps they're looking for growth strategies, help with marketing, help with our finances, etc. So we work with the whole spectrum of folks. We offer workshops and webinars on many business topics. Definitely encourage you to take a look at the newsletter. We have a lot of great topics this year, and watch for that information to come out to you. We also, and what the most important thing we do is our mentoring. Mentoring is free and confidential. And we work, like I said, with folks at all ages. Our mentors are volunteers that come to us with experience and knowledge that they have to share. A first session will be about getting to know what your goals are and formulating a plan to help you work forward. Occasionally, we will also bring in other mentors to help fill in any blanks needed along the way. It is statistically proven that those that are in a small business that come to SCORE at least 3 times are more likely to be successful with their small business. So we've got information to share with you. Should you like to get a mentor, you can put a note into the chat and just ask for someone to reach out to you, or you can go to our website, and I will put those links into chat here shortly. While you're there, take a look at previously recorded webinars. There's a whole library section with blogs and short presentations and templates that you can use, all kinds of great information. So I definitely encourage you to browse the website. Okay, so we're going to go ahead and get started because, and I do want to address, because I do get this question many times over. We are recording, and you can find that recording in approximately 24 hours. I will put the 2 locations that you can find that recording into chat as well, so that you will have that information so that you can find what you need. Okay, I'm going to go ahead and turn this over to our presenter today. Michael Sandman is a SCORE Boston mentor and very knowledgeable, and will do a great job explaining things for you today. So it's all yours, Mike.
Okay, well, with that introduction, I better do a good job. So what we're going to cover today are a little bit about, what are financial ratios and why we look at them, and what documents you need to calculate ratios, and the time frame that you should use, how often you should look at this. And Rob, if you want to chime in at any point about what the bank looks at as we're talking about specific ratios, please feel free to do that.
Sure, we'll do.
Okay, great. In fact, I may ask you a question, so keep alert. So we're going to look at liquidity ratios, and the source for that, typically your balance sheet, and operating ratios. Profit and loss statement is typically where you was not typically, it is where you find that information. And profitability ratios, both the P&L and the balance sheet can help you calculate profitability ratios, and working capital ratios, which come off of the balance sheet. And to start off, I wanted to show you a couple of examples of balance sheet and a P&L, or a P&L and balance sheet reversed, just so that we all know what we're talking about here. So this is an income statement from a hypothetical corporation, the YYZ Corporation. And it's this and the slides on the other examples that I have, and I have an example of a cash flow statement later on, come from something that was posted by Charles Schwab that I thought would make a good teaching tool. So this is just it's an imaginary company. And the sales of the company in 2022 were down a bit from 2021, 270,000 versus 350,000. When Schwab did this, it was in millions, but I thought, we probably ought to scale this back a little bit for us. Cost of goods sold, because it was selling a product, was 190,000. Gross profit was 80,000. They had some depreciation expenses and taxes, and there's a net income of 50,000 compared to $75,000. And if you were looking at that, you'd say, gee, how come? Well, what would you say? You'd say, how come profits are down? How come sales are down? Well, clearly profits are down because sales are down substantially, but why? What's going on in the marketplace is something that you would certainly ask yourself. But as we look at some ratios, we're going to see what that means to someone who is providing loan, or anybody else who's providing capital, and also thinking about how you want to operate your own business. So we'll use this as some for examples on the ratios that come off of the P&L. And this is a balance sheet, same company. They have $92,000 in cash currently, $50,000 worth of accounts receivable, and $30,000 worth of inventory, and that's their current assets. And current assets means assets that can be turned into dollars and cents fairly quickly. And obviously the cash can be, and they're expecting to receive in 30 days or 60 days all of their accounts receivable, and presumably their inventory is valued at a reasonable level, so that they could turn that into cash. So current assets, $172,000. Current liabilities, what they owe people within the next 30 to 60 days. Accounts payable, well, actually, technically within the next year. Accounts payable, 30,000. Short-term debt, 20,000. So they have current liabilities of $50,000. So that, on the face of it, that looks pretty good, and we'll see that the ratio, in fact, conforms very nicely to what we say is a good ratio. They have long-term assets of $230,000 and buildings of $90,000. So that's their total long-term assets, and that's assets that have value, but that value typically can't be realized in the just immediately. You can't call up somebody and say, here's my equipment, I'm going to put a price on it. You got to find a buyer for that person, and the same with the building. They have long-term debt, that is, they have a mortgage or they have bonds or something of that sort. So those are long-term liabilities of that, and that's $200,000. And so what's left over, basically, is the owner's equity. That is, this is what the owners have available to them if they were to liquidate the business at fair market value. So if they got all of the money for their current assets, paid off all of their current liabilities, got all of the money for their long-term assets, and paid off all of their long-term liabilities, they would have $242,000 left, because they put in $2 for their shares of stock initially. They were paid in capital. They put some additional money in, another $148,000 in capital when they started up, and they have accumulated over a period of time profits that have ended up in retained earnings that is the money that they've kept inside the company, not paid out to themselves, of 92,000. So they've got $242,000 of shareholders' equity. So, and if you look at the 172 and 320, that's 492,000 minus, sorry, yeah, 492,000 minus $250,000 worth of liabilities. That's where the $242,000 worth of equity comes from. So that's a typical balance sheet. This one is not very complicated. It's meant to be simple. Now let's look at the ratios that we can get from these two balance sheets. And virtually all of you who are running a business will have seen these sorts of statements come out of your QuickBooks or some other financial software or from your account. So let's start with liquidity ratios. They help you understand if you can meet your short-term obligations using cash or cash-like assets. So a cash-like asset is receivables or inventory that you can sell. And it helps you understand whether you can avoid default or bankruptcy. You have to be able to meet your short-term obligations because otherwise you are technically in bankruptcy. Bankers, analysts, and creditors look at these in particular, these two, the current ratio and the quick test ratio, so-called acid test ratio. So let's look at how we do those. So the current ratio is current assets divided by current liabilities. And if the number is greater than 1.5 or 2, it's really excellent. Less than 1 means that the company really isn't solvent in the short term. If you had to pay all of your current liabilities off, you don't have the money to do it. And you haven't got a way to get that money unless you were to require some additional capital or borrow. And the quick test ratio is current assets minus inventories. So basically the cash and receivables divided by the current liabilities, because there's an assumption that if you really had to move quickly, it would take some time to sell off your inventories. And there, a number again, greater than 1 or 1.5 is very good. So let's look at exactly that. Here's the, oops, let's go back to the P&L, I'm sorry. There we go. Now, sorry, the balance sheet. Confusing myself here, I apologize. Let's go back to the balance sheet. And you can see that total current assets, remember, was 172,000. Total current liabilities is 50,000. So that ratio is really good. That's 3.3 or 3.5 to 1. And we had said a good ratio was 1.5 to 2 to 1. So very simple calculation, 172 divided by 50. And that gives us the number. If we were to take inventory out of that for the acid test ratio or quick ratio, we'd get 142 divided by 50, still very close to 3. Excellent, excellent number. Okay. Any questions about that? Put that up in the chat, but that's a very simple one to pull right off of your balance sheet. And it's something that almost anybody lending you money, or for that matter, giving you credit, would want to take a look at. And it's useful yourself. This is a test for yourself, even if nobody ever asks you, how am I doing? How do I measure my financial health inside this business? Current assets and current liabilities are key markers of the financial health of the business. Okay. So operating ratios. The operating profit percentage is the percent of sales that result in a profit before taxes or miscellaneous income. So how much profit am I making on my revenue? And it helps you determine pricing strategies, cost reductions, and so forth. If your operating profit percentage is very high, so let's just take the example of Tesla, which has very high has had very high operating profits. And they were able to look at the market for electric vehicles, see that new competition was coming in, and they decided to cut their prices on some of their models because they could. Okay? If their operating profit margin had been less, substantially less, they wouldn't have been able to do that. So this is a number that it doesn't tell you you should cut price. What it tells you is you could cut price if you wanted to, or perhaps it's telling you that you ought to think about whether you can raise prices. And it tells you whether you should be looking for cost reductions in order to improve that. You know, just how am I doing on my day-to-day profitability of what I'm selling? Inventory turnover is the average inventory divided by the annual cost of goods. So for those of you who don't have inventory, if you're in a service business, where you're never bringing in anything that you own and then reselling it, this doesn't apply. But it's an important number if you're a retailer, if you're selling products on the internet that you're, excuse me just a second, got a background noise. Sorry. Too many channels into this audio. Average inventory divided by the annual cost of goods tells you how often in a year your inventory gets depleted or needs replenishment. So I have a question for you to think about. Is a high inventory number good, or is it bad? Or, you know, just think about that a second. And we're going to take a look at, you know, calculating the operating profit and inventory turnover, and then come back and we'll ask that question again. And if, in fact, if you have an answer, you're welcome to put it up in the chat. Here's the income statement. Remember, we saw this earlier. And there's, let's take 2022. There's $270,000 worth of sales and net income of $50,000. So you take $50,000 and divide it by 270,000. And let's do that. And it's 18.5%. And that's a pretty good profit ratio. Generally speaking, if your profitability is somewhere between 10 and 20%, you've got a good, healthy business. But it'd be interesting to look at what it was the previous year. So again, let's take 75 divided by 350, and it was 21%. And that makes perfect sense because there's overheads and so forth that this company isn't covering as well because of the drop in sales, and so the percentage of profit has dropped a bit. It's not bad, 18.5%, still very, very good, but it was earning over 20%. And then let's look at let's go back for a second and look at average inventory, and you can see that sorry, let's go back and so it's the inventory dollars divided by the annual cost of goods, and the inventory comes off of the balance sheet. By the way, we had back here on the balance sheet $30,000 worth of inventory, right? And now the annual sales of $270,000. So 270 divided by 30 is 9 times. That means that inventory is turning over 9 times. It comes in within about 6 weeks or so, 5 or 6 weeks, it's gone out the door. And so now let's go back to that question that I asked about what the inventory turn situation is a high inventory turn good? Is a low one good? High inventory here's an answer in the chat. It's good if you need to be able to respond quickly to bursts in demand, but if you have high costs in maintaining that high inventory, it affects your available cash to meet expenses. Okay, so that's a reasonable, absolutely reasonable statement. It's good to have lots of inventory, but if you do have lots of inventory, the inventory turnover number is going to be lower. So if we had, instead of $30,000 worth of inventory, we kept $90,000 worth of inventory, the inventory turnover would only be 3 for this company. So that 3 tells you you've got a lot of money tied up because you perhaps want to be able to respond quickly, or it may mean that you've got too much inventory and sales are slowing and you need to cut back on what you're bringing in. So a high inventory turnover number tells you that you're using your money very efficiently. A low inventory turnover number tells you you're not using it as efficiently, and depends on the kind of business you're in. You may want to think about trying to reduce the amount of inventory that you're carrying during the year, freeing up some cash to use for something else. But the point that Eric makes here is a good one. That, you know, if you have a business that has to respond quickly to changes in demand, then if you can afford it, to carry high inventory is a good thing. And there's sometimes a problem with low inventory, because if you run out of an item or a group of items and there is a bump up in demand, you can't satisfy that demand. That's a lost sale. So you have to find some balance here. And we're just looking at the ratio, whether it's a turnover of 9 times, as we have with this company, or 3 times, or whatever it is. That number is a guide to how well you're using your financial resources in order to maintain inventory. And you have to think about, well, what's typical for my business, and how do I compare to prior years? So there's no hard and fast number. It really does depend very much on the industry. And I don't know if Rob is back on, but if you wanted to make a comment about inventory turns and the way the bank looks at that for different kinds of businesses, you're welcome to do that. And if not, that's okay. We'll just keep going. No, we'll just keep going. Okay. And so Luis says, depends on the industry. Selling a boat, a company selling a boat will have a high inventory, and then selling a pound of flour because the boat is a big expensive item. Yeah, that's generally speaking, that's true. But again, I want to make sure that we understand that we're not talking here. I'm not asking about whether the inventory number is high or low, but rather the turnover number is high or low. It's the sales divided by the inventory. So I'll say that one more time. It's the sales divided by the inventory. That number is a good measure of the efficiency of your use of capital in your business. And again, it depends on the industry as to whether that inventory turnover number should be 6 or 26. Well, 26 would be pretty unusual. That would mean that you'd be turning over your inventory less than every 2 weeks. Which would be extraordinary. Okay, so that's the profitability ratios, right? Let's take a look at working capital ratios. So gross working capital is current assets minus current liabilities. Remember, we looked at that earlier. The more you have, the less you'll need to borrow. And so let's go back and look at the balance sheet again. So remember, we said this company was really well capitalized, had current assets, total current liabilities. Is a very strong number there, over 3. That company has a great position in gross working capital. Another working capital ratio is debt to net worth. So it's the total liabilities divided by the shareholders' equity. If your total debt ratio is lower than 1 or 1.5, that's good. A higher ratio indicates too much reliance on borrowing, and that, that's a general rule, but it's also subject to seasonal variations, because a retailer who does a lot of business at the Christmas season, or a business does a lot of business in the summer, will have borrowed money, a lot of money, perhaps ahead of that season, in order to bring products in and then sell those products and reduce that inventory, and their liabilities, their accounts payable, what they have to pay for all that inventory, will be going down. So take this with a little bit of a grain of salt if you have a highly seasonal business, one with a lot of seasonal variations. But again, let's look at the numbers. So it's total liabilities divided by shareholders' equity, and we have total liabilities of $250,000 divided by shareholders' equity, 242. So that number is a little bit less than 1, right? Let's calculate it exactly. It's 250 divided by 242, and that's well, sorry, it's 1.03. Okay, that's not unreasonable, but there's a fair amount of long-term debt here in this company in comparison to the shareholders' equity, and certainly going back and looking at the profit and loss statement, you want to think to yourself, how come my sales went down? Are they going to go back up next year, or are we on a downward trend? Because if we're on a downward trend, we're going to have some trouble generating enough profit to pay off our long-term liabilities. We want to be careful about that. And similarly, somebody who's lending you money would want to be looking at that. Okay, so those are our working capital ratios. Gross working capital looks pretty good here. Debt to net worth, not quite so good. Not terrible. Remember what we said, if it's lower than 1 or 1.5, that's good, and this one is just a tiny bit over 1, so it's kind of borderline. Okay, so I want to stop here, and then I'm going to start again on one other thing that is really outside of the financial ratios area, but I do want to talk about very briefly, and that's the third statement that you typically get. We looked at the P&L and the balance sheet. There's also, typically you'll find a cash flow statement or a uses and sources of funds statement in your accounting statements. And I want to explain just a little bit about that. But I want to take any questions that we have here. Let's see what we've got. If you lease a space, what kind of liability is that considered if it's a multi-year term? So you have to talk to your accountant about that, but it may very well be a long-term liability. And except for the current portion, this year's rent. So I have a 5-year lease, and I'm paying $100,000 a year. I've got $100,000 worth of current liability and $400,000 worth of long-term liability, and that's typically the way it will be defined. It really depends a little bit on what the terms of the lease are, but that's and by the way, the same thing sometimes applies if you're buying equipment on a lease. So if you're buying a vehicle or you're buying some machinery on a lease, the same sort of thing applies. So we've got all the questions answered. So let's go back over here.
Go to the chat questions, please. We got some in chat. Our
buildings or vehicles requiring expensive maintenance considered liabilities. The person who owns a car will tell you about that. So the liability is, there's nothing on your books unless you have a contract for maintaining that vehicle or that building. But it's an operating cost that you have to be aware of. It's going to affect your profit and loss statement in each successive period. So if you have to spend a lot of money each month on building maintenance, for example, it lowers your P&L. Therefore, it's going to lower the ratios that depend on profitability. So all by itself, that doesn't affect your financial statement. It's not a line on the statements, but it is something that affects profitability, and therefore you have to be thinking about, well, is there a way to reduce those costs if you possibly can? If you're a mobile services provider, so a liability is something that you owe somebody else in one form or another. And it's the classic liability is you have bought a product or a service from somebody and you haven't paid for it yet. That is an accounts payable, and that is a liability. Another form of liability is if you have borrowed money. If you borrowed money that you have to repay in a month, that's a short-term liability. If you've used a credit card or something like that, which we recommend that you do not do to fund your business, that's a short-term liability. If you're, because it's due within a year, if you borrowed on a mortgage or something of that sort, that's a long-term liability. And it really doesn't matter whether you're providing mobile services or concrete. It's what you owe somebody else. So look at your, look at your accounting statements and see who you owe what to, and those are your liabilities. Let's see. Good. Devin's joined us. Debt service ratio. If I don't cover it, Deb, if you want to go ahead and get into this. This is Deb Dobbins from East Cambridge Savings Bank.
Sure.
Thanks for joining us, first of all, and welcome aboard. And if you want to talk about debt service ratio, please do. Which one you want me to go back to the balance sheet? Would that be helpful?
Good question. Well, I would say maybe why don't we talk about it when you get to the cash flow sources and uses?
Okay, sure. Yep. All right.
Sorry I was late, but thank you for.
No, that's okay. Welcome. Income outcome. I'm sure I don't quite understand that question. LaQueen, do you want to just, if you can add into the chat what you're referring to, that would be helpful. Income is, just broadly speaking, income is what's left over after you've brought money in from your customers and paid all of your expenses in the year. Okay. Let's see another one here. Purchased and retrofitted a shed to use as my corporate headquarters. I use my own personal funds and it's a rent-to-own contract. Can you transfer that debt over to the company? Yes. Talk to your accountant about how to do that, but also talk to the lender to make sure that it's okay with the lender that you're doing that. The lender may say, yeah, but you have to be the contingently responsible for that. That is, if the company doesn't pay, if your company can't pay for it, then you have to pay for it. I paid for insulation, electrical, flooring, and walls as well. Okay, the website, we're going to leave the website alone for a second. The insulation, flooring, and walls all go into, if you paid for a building, it's an asset. It goes on your balance sheet as a positive. You put some money into it, you typically will depreciate the value of that year over year over time. Again, an accountant can help you with that, but anything that went into the building, insulation, flooring, walls, absolutely. And then you took a loss on the website, you paid, that's an ongoing expense. It reduces your profit for that year. And it reduces, if it reduces your profit, therefore it reduces your tax liability. So that's about as much of that as you can recoup. If you're paying taxes, if you have a profit, you're paying taxes on that profit, it will go down by the amount of tax that you would have paid on that $700. Outcome, paid out expenses. Okay, so let's just go back and take a look at the P&L. So here are this is the sales, okay, $350,000 or $270,000 in the following year, and here are the things that are going out. The cost of goods sold, that is the product that YYZ Corporation is bringing in to sell. This is the gross profit before depreciation. This is a very simple P&L. And this is depreciation on equipment or something of that sort. And this is their taxes. And that's what's left. Okay. So that's income after all expenses. It's really important to remember that revenue is not income. Revenue is what you start with before any expenses are paid. And you have to cover all of your expenses, and what's left over is profit or net income. Okay. All right. Okay. So Deb, if you want to go back to, I'll pick up on cash flow, and then you jump in where you want to. Okay.
Sure, thanks.
Okay. All right. So we have a bonus, reading cash flow statements. And this is, again, the statement of cash flows for a different corporation. For some reason or other, when Schwab put this up, they didn't choose to use the same numbers from the prior one, but okay. And let's say that they have income, net income of $30,000, and plus depreciation. Okay. So remember, depreciation is an expense that you use to reduce your profitability and therefore reduce your taxes. And it recognizes the fact that the fixed assets that you have, the building, the car, the software that you purchased, the improvements that you made to your storefront, those decline in value over time, but they have continuing value. They don't lose all of their value in the first year. So you write down their value year by year according to the rules that the IRS has established for different kinds of assets. But when you're doing a cash flow statement, you've already paid for that building, or you've already paid for those improvements in the prior year. So even though you're taking $15,000 worth of depreciation off of your profitability, it goes back in as a source of cash. That, what I've just described, is a black hole of a mystery to a lot of people. But I think the easiest way to understand depreciation is it's money I spent in a prior year that I don't have to spend this year. I've already spent it. It's come off of my profit, but in fact, I've got the cash, even though I've written an expense line for it.
So just to say one quick thing on that point, Michael.
Right. Yeah.
So the bank considers it a non-cash expense. So when you're calculating your free cash flow,
Yeah.
you would add back depreciation and any other non-cash expenses like amortization or whatever other mystery things might be there.
Right.
Because you're trying to determine a free cash flow number, right?
Right. Right.
So I'll say more about that in a minute, but I just wanted to make that point that it's considered a non-cash expense.
Right. Okay. And so because it's a non-cash expense, it goes, you take it off of, you take that same number off of the P&L, the expenses on the P&L, but you put it back in as a positive in this.
Exactly.
Right. Okay. You had a decrease in, this company had a decrease in receivables. That is, it has less money owed to it by its customers. So that means that it's actually turned some of those receivables into either it's turned some of those dollars and cents into cash, or it's used up some, or some of its cash has gone into receivables. It's had a decrease. It has had an increase in inventory. It spent some money. Spent some money on adding to its inventory. And there's been no change in accounts payable, what it owes to others. And so you add up all of these numbers, and there's a $15,000 increase in cash from operations. And this says case, and I apologize, but that is Charles Schwab's typo, not mine. There's been an increase in cash of $15,000. The company has purchased equipment for $150,000. They borrowed $100,000. And so the net change in cash is a drop in cash of $35,000. So $15,000 here. Brought in $100,000. That's bringing in, that's an increase of cash of 115, less the 150 spent on equipment. Negative number, $35,000 decrease in cash. Cash at the beginning of the year was 127,000. Cash at the end of the year, $35,000 less, 92,000. So, Deb, if you want to talk about the way you look at the at this, that would be great. That'd be very helpful.
Sure. So between this statement and the income statement, a banker would calculate what's called the earnings before interest, taxes, and depreciation. It's called,
Right.
it's referred to as EBITDA. And that's used as basically a proxy for free cash flow.
Yeah.
So that number, let's say in this case, I can't tell from here because we don't see an interest expense or cash pay. Actually, in more detailed statements, there'll be an interest expense number, but there'll also be a cash interest paid number. So
Yeah.
that would be the number you would add back to net income, depreciation, and taxes. And then you take the annual debt service. So for simplicity's sake, let's say you get an EBITDA number of 100 and you have a debt service, annual debt service number of 50. The debt service ratio is EBITDA divided by the debt service payment, debt service paid. And in this case, it would be 100 over 50, so it would be 2 times. Most banks have a minimum requirement of somewhere between 1.25 and 1.30 for a C&I, a business loan, and sometimes it's a little lower on real estate. So that would be how you calculate the debt service coverage ratio.
Okay.
And then it can get more complicated if you have other non-cash expenses, or even if you have one-time expenses and you want to have a conversation with your banker about why you would want to exclude, add those back because they're not recurring. So the EBITDA number is calculated to derive what a recurring free cash flow number is.
Yep.
Is that clear to everybody? Thank you, Michael.
All right.
Robert and I are glad to take more questions at any point if you want.
Okay, great. Well, that's something that we have to add into this on a regular basis. I plugged this thing in when I looked at the information, the presentation that has been used previously. I thought, well, we have to look at cash flow here because people need to see this thing. Let's go back to Eric's question about. Wait a second. A business could be losing money, that is, be unprofitable, but because the building they own has depreciation, and therefore part of that loss is the expense of depreciation, this would make it look like they have positive cash flow. And the answer to that is yes. Okay, that's exactly what could happen, and it probably wouldn't happen for very long. Because the company would eventually run out of money if they're not making a profit. But companies do sometimes live off of their depreciation for a while if they're in a down period. And so I know it's confusing to say that I could be having a negative profit, a loss, even though I've got a positive cash flow. Because of depreciation, but that is, in fact, you in fact do have that cash still sitting in the bank. You haven't spent it. You've allocated it back to taken it off of your profit and loss statement, and it's basically allocated back to some prior purchase of an asset. So let's go back here. All of these resources, including the presentation, including cash flow, can qualify a business for a bank loan or letter of credit. So I think I should let the bankers answer that question, but I'll give you mine very quickly. If the numbers look good to a banker, that will be a positive in establishing whether or not you can get a loan. And either Deb or Rob, if you want to respond to LaQueen's question, that would be great.
I'm not seeing what the question is.
Oh, it's in the chat.
Shot.
Yeah, and it's up, it's at 10:41 is the time stamp. It says LB over on the left. All of these resources included in this presentation, including cash flow, can qualify your business for a bank loan or letter of credit from a financial institution, question mark? You see that?
Yes, yes.
Okay, good, yeah. So, and my response was, well, you know, assuming that the numbers look good to the bank, then all of this information is input into the decisions that you folks make.
Yes, correct.
Okay. Back up. Okay, we talked to Eric. Eric, is that, I hope that's clear. A building is an asset. Yeah, that's true. Does Deb have an email? Everybody has an email.
Yes,
So-
Teresa will send it along.
Yep, great. It's tricky for a bank to see the reality of a company, right? Well, these numbers help. And that's why the bank wants to see these statements. And again, I'm going to refer back to the folks at East Cambridge Savings Bank to because this is why they're there in the first place, is to make these judgments. How, you know, what do you how reliant are you on these sorts of things when you think about a loan?
Very reliant. It all comes to cash flow and financial statements. Of course, there's other things, the business plan, the character of the principal or principals. There's numerous other factors that come in, but in the end, it all comes down to cash flow and debt service coverage. Does that help?
Okay. It helps me, but certainly the financial statements are very important, and that's why it's important for folks to understand them, because they're, you know, 50 or 75 or even 90% of the way the bank looks at the company. And it, you know, it depends to some extent on the size of a bank. The experience that I have is that small businesses, even medium-sized businesses, are far better doing business with a local bank, because when they go to a big bank, it's all about the numbers and there's nothing about the character of the borrower, or at least not very much. Okay. Okay. So Laquina, contracts, personal family grants, community loans, and community grants. Not sure where you're going with those questions. If you want to add something in, that would be great. Last one, is it better to use personal savings to cover expenses and downtimes, or a credit card that has a temporary period without interest? Okay, so the risk of a credit card is that for one reason or another, you'll go past that period with you know, that no interest period, you know, the one of these things where you transfer a balance or something of that sort, and you get you have a no interest period. If you're absolutely disciplined about paying it off before you have to pay interest, great. But as soon as the interest starts, it's going to be very substantially higher than what you would pay a bank. So be really careful about that. And if you're in a situation where you have to think about that using personal savings or a credit card, then take a really careful look at your business and make sure that you're comfortable that it's going to recover, that downtimes aren't permanent. And think about what you might have to do to help it recover. But be really careful about credit cards. Okay. Building on cash flow, which is what Deb was discussing, the bank loan. Oh, okay. So the question you're asking is, where to go here? How do contracts, personal family grants, community loans, and community grants play into the way the bank views your business. I mean, debt is debt. It really doesn't, seems to me, but again, I'm willing to be corrected. If you owe money, if a family's giving you money, that's capital that is in your business. That's great. If you've gotten community grants, same thing. You don't have to pay that back. If you have loans or loans from family, loans from community organization, and you're obligated to pay those loans back, that's debt, and it goes into the liabilities part of your balance sheet, and it makes the business slightly less attractive or less attractive as a loan customer. Okay. Okay, we don't have any more questions. We're just about very close to the end of the hour. Either Deb or Rob, if you want to just close with a couple of words about East Haven Savings Bank, and we'd be happy to have you do that. Sorry, you don't need to add the grant use here. Grant is income basically, and it's one-time income, and it's not, it doesn't become a liability unless if you don't have to pay it back, it's not a liability. Okay, Rob, go ahead.
You want to say anything? Do you want to say anything, Robert?
Yeah, I mean, if anybody has any follow-up questions, feel free to reach out to either Deb or myself, or go to your local community small savings bank, and you're more than likely to be able to sit down with a commercial lender and ask as many questions as you want. Again, the small community banks are much more willing to work with small businesses compared to the larger commercial banks.
Yep. Yeah, that echoes what I said earlier. You're far better off working with the local bank. There are couple more things that popped up here. Are there ratios that are particularly important for valuing a business for potential sale? So I would say to you, as somebody who has both bought and sold small businesses, the profitability is really important. That the ratio of profit to sale. So if you remember way back at the very beginning here, we said that the company that let's go back and have a look at it. That this company was earning 18% on its sales. That's a really strong number. And if that number is under 10%, a buyer is going to look at that and say, the buyer is always going to ask, once I buy this, can I sustain that profitability? But that ratio of profit to sales is a really important one. And then anybody looking at a business is going to say, well, what are the liabilities and the assets and so forth? They look at the balance sheet, but profitability tends to be the key thing.
So Michael, one of the things I used to see when I was in the corporate banking market is the valuations were often done by a multiple of EBITDA and sometimes by a multiple of sales. Did you ever see that in this segment of the market?
EBITDA doesn't tend to be, with small businesses, doesn't tend to be as much of a consideration. Sometimes, once you get above $5 or $10 million in revenue, I've seen that. But generally speaking, not so much. It's just pure, what's the profitability here? Unless the company is heavily leveraged or something of that sort, then you might see that that is a consideration. And how can I get a grant? Well, I'm going to give you a simple answer, and it's going to sound like a wise guy answer, but it really isn't. And I promise that. You have to apply. You have to be eligible, and you have to apply. And there are organizations, community development corporations that may be willing to give a grant. There's one that I'm well acquainted with. It's the Dorchester Bay Economic Development Corporation. They sometimes will provide a grant to a business, but there are other community organizations that they're particularly interested in fostering small businesses of a certain sort, and they may give a grant. There are municipalities that give grants. I live in Brookline. The town of Brookline gave grants using federal funds, federal COVID relief funds, gave grants to something like 15 restaurants in order to help them recover from COVID. And profit to sales ratio based on gross profit after cost of goods sold. Profit to sales ratio based on profit to sales. It's net profit is the answer. After it is typically what we're talking about for percentage of profit, the profitability percentage that people tend to look at after all expenses. Does the city of Boston give grants? Yes, and that's about as much as I can say. There is an economic development office in Boston that will be able to give you a lot more information. Net profit before taxes and depreciation. Well, I think the answer is, so Deb and I were just talking about earnings before interest, taxes, and depreciation, EBITDA, and amortization. That is net profit before taxes and depreciation. The net profit number that I'm used to seeing, and I think is the appropriate number if you are trying to figure out how your own business is doing, is net profit after taxes and depreciation. And there we go. Cultural community grants that the City of Boston offers to small businesses. These do exist. Okay. Thank you all very much. Deb and Rob, thanks very much for your sponsorship of this and for your contributions to the discussion. If anybody has any questions, certainly email them in and we'll see if we can put it back together and give you an answer. And again, you'll receive the PDF of this and a link to the recording. So thank you. Teresa, back to you.
Yes, thank you, everyone. We'll get that email out to you either later today or part way into tomorrow, and it'll have all the information you need to reach out should you desire to, and it will have the recording information and all that good stuff for you. So thank you, everyone, and have a good day.
Thank you. You too,
Thank you.
Teresa. Thank you, Michael.
Bye-bye. You're welcome. Bye-bye.